Okay, good morning to everybody. Today we will have a company update on SGX, the acquisition for the Baltic exchange, and also a sector update on financial services. We'll talk about the some of the structural issues that is challenging the securities market. And finally, we will have the company results for Soilbuild Business Space REIT. Okay, so here are some of the highlights which you might have already read in the media, but we like to actually highlight the operating profit growth for the Baltic exchange because the media has actually put forward the numbers for the net profit, but the operating profit itself is actually up 34% from FY15 to FY16. The net profit that the media has reported includes all the trading gains and losses, mark-to-market losses, etc. So in order to have a clearer picture on its operations, I've put up the operating profit here. And generally, the core business which SGX has been speaking of, right, like the fee arrangements for clearing houses and the information sales, as well as the adoption of the Baltic's platform, has been quite good. So there's some background here of the Baltic exchange. It's established in 1744. It traces back to a culture where ship owners, etc., they will congregate at a coffee house and exchange information. So from there, it has evolved to an establishment, an institution, where it primarily functions as a utility to provide services for its own members and owners. So in that sense, the Baltic Exchange is owned by its owners, and its customers are also its owners. So in that sense, this the setup is not very much a profit-oriented establishment, and SGX hopes that from acquiring it, it can have increase its commercial purposes. So as you can see here, there's this, it starts from an OTC market, and then it's moved on to actually a cleared market. And as of 2006, right, the cleared market was only about 10 to 15%. As of today, it's already 99% cleared for the FFA market. So the FFA contracts are marked to market daily and are settled monthly against the physical index. And this physical index, the market pricing, is provided by a panel of physical ship brokers. So you can look at the FFA as similar to our stocks CFD, contracts for difference. So while there is owning the stocks outright, where you have the rights as a shareholder, the CFD part does not give the trader any rights to as a shareholder. So you can look at this way: you can own shares, you can long it, but you can use CFD to hedge your long positions. At the same way, physical ship owners, they have long positions, and they can use the FFA as a hedging tool. So the underlying for FFA is the Cape, Panamax, Supramax, and Handy, etc. These terms refer to the size of the ship, and the second part is the period. How long will you expect the ship to be out on the journey? So the hedging strategy would be when the ship is out on voyage, the rates will fluctuate. So during that period of time, ship owners can use the FFA as a hedging tool to reduce the volatility, or to avoid some losses from the volatility at the end of the voyage. And here's an example of a hedging strategy. So you can refer to this as a good example. It shows you that the ship owner has the physical side of the trade as well as the derivative side of the trade. So revenues are earned from SGX point of view. The revenues are earned from two ways. So one is earning clearing fees, license fee from clearing houses. And now, of course, if SGX has already purchased the Baltic exchange, it has option to clear it, the FF trades themselves, or to license it out to some clearing houses, or a combination of both. And the second part is actually the provision of information services. As it is, SGX has already got the pricing for coal and iron ore, and now it adds to its table of products, the FFA trades. So when you put them all together, they are able to have a very, it's like pieces on the jigsaw puzzle, they have a very clear picture of the entire trade, right, seaborne trade. So this information can be used, can be sold to interest parties like financial entities that provide trade finance. And the use of this information can help these entities to better estimate shipping costs and help them to manage risk. So here's the value chain, and in order to help laymen understand the value chain, I would compare it to Property Guru, for example. So Property Guru is a platform where the housing agents will put up prices, right? So it's actually where you get all the prices put up on the platform for the market to see. As for Baltic, for the Baltics itself, it works the same way. So you need the panelists, right? And the panelists generally are the shipbrokers. They will have to put the price up there, and so that this is can be used as a reference, right, for the market. And what happens is that the with more information, you get a deeper and more expensive market reading on the shipping market. And then with better information, efficacy of the information, you have more participants. Maybe banks and financial institutions will come in and trade the FFA. And with increased volumes, of course, you have higher clearing fees, and you have more revenue from information sales. And then it feeds back again, right, that if the brokers continue to find that the FFA benchmark is useful for market reading, they will contribute more. But most importantly is that in this this value chain, right, the enhanced price discovery does not deflate the commission for the ship brokers in the physical market. Because likewise, in Property Guru, when they when this platform is out, people question whether such a platform would actually disrupt the useful role of the property agents. So finally, the objective is to grow the derivatives and the paper market to multiple times of the physical market. And one of the most popular comparison would be gold, where gold now is trading approximately 500 times of its physical. Here's a list of the panel reporting companies that is currently on the Baltic exchange. And so, as a conclusion, we believe that the straightforward derivatives is still reflective of the physical market. It's not disconnected yet, because SGX will still need time to engage the Asian participants and to try to engage them and to encourage them to use the FFA as a hedging tool. But in the near term, we think that the market connectivity and data business segment would benefit before the derivatives market. As it is, with that wealth of information together with the existing business in coal and iron ore, they can already package a comprehensive product for other parties to use as for their risk management. So we do not think that there's any significant impact on acquisition synergies for the next 12 months. We'll monitor the progress, and hopefully it becomes accretive after some time when SGX actually carries out its strategies. So finally, for investment action, we maintain accumulate with an unchanged target price of $7.99. Okay, next we will look at some of the challenges on the securities market, and these challenges we feel are structural issues. There may not be anything that the SGX as a company could, as an establishment could help much. But what we can try to do is to wait for the cycle to turn, and hopefully things will become better. So here are the two global challenges that is already taking place and that might affect the Singapore securities market. First is the rise of privatization due on a global scale. Demand from private equity as well as corporates are pushing up the buyout-backed exits. So the weak stock market valuation creates this opportunity and a wealth of companies, a very strong supply of companies, Singapore-listed companies that are becoming increasingly attractive to this private equity and corporates. And the second part is the lack of IPOs. Recently, there's of course a lot of companies that remain private and they are venture-backed startups. And most of these startups, especially in Southeast Asia, are not looking to IPO. Firstly, because they are continually being backed by venture capital. And second part is that we'll further elaborate that they are positioned more as acquisitive targets rather than standalone IPO-ready entities. Okay, so first the privatization deals. As you can see that the performance for buyout funds have consistently outperformed the public markets. This raises the performance expectations of many customers, right, who would put their money with these funds. And this has led to a growing private equity dry powder that's pressured to put into new deals. So as you can see that leading up from 2011, there's a steady increase in the amount of buyout dry powder. And there's more M&A demand from corporates so that seek to expand their business supported by low cost of capital. So in this chart in 2015, there's a huge spike, right, in the global M&A by value, and the bar here, the light gray color, it shows expansion of M&A transactions by value in Asia Pacific as well. And considering the amount of funding that is going into the buyout funds, right, these fund managers are increasingly pressured to put them to work, and so it's demonstrated with the highest EV over EBITDA multiple that they are willing to pay to buy out public companies. Although this chart is for the US public traded US public traded companies, we believe it is emphatic of the global scene, and it would also affect Singapore. Why so? Because Singapore has been languishing, the public markets have been languishing, and this has brought the EV to EBITDA ratios very low. And the next chart will show that, okay, in this chart we'll show that actually the number of companies in Singapore that has emerged as a potential privatization target is about 59%. This is based on the threshold that we have here on the data, and this makes Singapore a very attractive destination for some of these buyout funds. And one area that you might be interested to look at also is the offshore oil and gas companies. They have been beaten down, and with rights issues, with pressure to raise capital through rights issues, that will also come down, and this will actually reduce the enterprise value. And these companies, if they reach, they still have some cash flow, right? And this ratio reaches this attractive value, then they would be a very, very strong potential target for for these takeovers. Okay, so as for IPOs, here are some of the numbers. Right, the Singapore startup funding has reached 275 million in 37 deals as for the first quarter of 2016. As compared to first half of 2016, the IPO market is 1.6 billion. But bear in mind that the Singapore IPO market, 1.6 billion for first half, is boosted by the Manulife REIT. So in that sense, the startup funding comes up very close to the IPO market for this year. So we would say that if they had not been funded privately, these startups could be potentially a very good source of IPOs. But unfortunately, that has not been the case. So one of the examples would be Garena. It has raised 170 million in Series D funding, but has continued to remain private. So the continual supply of VC is enough to keep these startups away. So one of the reasons in the Southeast Asian landscape that encourages startups to remain private is because these startups are positioned to increasingly positioning themselves as acquisitive targets. And one of the reasons is because the demand for foreign companies to expand to Southeast Asia is met with some challenges, especially the protectionist legislation in most of the ASEAN countries. So you have a very fragmented framework to expand within the ASEAN countries. And those startups that have the ground knowledge and is able to create that ASEAN infrastructure would be a very attractive targets for acquisition by these corporates who seek to plug and play and gain quick access to the Southeast Asian markets. So this has resulted in actually a very large number of M&As in Southeast Asia. So the number comes up to 43% of the M&As in Southeast Asia are made up by the foreign companies buying them. And this creates the kind of momentum for these startups to continue to look at making strategic progress in that area of being acquisitive targets rather than being IPO ready. So the last part would be a direct challenge to the securities trading scene here in Singapore. And this is the data from the Singapore Asset Management Survey from MAS actually corroborates with our idea that it's very much of a macro challenge to the industry. So what is most striking is the statement here from the forward. It says that as the public markets returns disappoint, more investors are seeking excess returns from illiquidity and market risk premium in private markets. So what makes matters worse is the low interest rate. So the low interest rate actually compresses the credit risk premium, which means is that the funds would be chasing chasing the higher valuations for much lower returns, and they have proven, at least especially in the last 2 years, that they can compromise on the liquidity. So what has been resulted is that the traditional AUM grew only 4%, while the alternative AUM has expanded 29%, and this expansion is led by the growth in private equity and venture capital. So institutional investors have accounted for more than 60% of the source of funds for alternative asset managers. And the pie here that you see here is the 60%, while the other 40% are fragmented source. So of this 60%, most of it is made up of the corporates as well as the pension funds. And this further corroborates with the global picture that corporates are seeking investments in M&A deals and buyouts, and in venture capital as well. And this last point shows that while the alternative assets are growing strongly, it has affected the allocation to equities, and overall it has um, made allocation to equities decline from 2014 to 2015. While it's just a marginal $10 million decrease, we believe that the effects on trading would actually be a lot the effect would be a lot greater, because a slowdown in growth itself would have a negative effect on the amount of trade on volume being traded, and that's not to mention that a decrease would have that disproportionate negative effect. So as a conclusion, we can see most of the symptoms that we see today, right, the negative impact, could be traced back to the interest rate, right? Because the low interest rates have caused returns of investment to fall drastically, and investors seek alternative forms of investments, such as P and VC, to increase the returns. So conversely, we believe that the increase of interest rates will raise the expected return on these private equity and venture capital disproportionately, thus making it less attractive. And with high interest rate, and although high interest rates would also affect the public markets, as the discount values are higher, but the public equities have the liquidity and the price transparency. So in that sense, we believe that funds that would compromise on illiquidity today may not look at it the same way when interest rate rise. They may actually redirect their attention to asset classes with better liquidity. So with increased interest rate, we can also expect asset allocation to be balanced. Leverage buyout definitely will be less aggressive because the cost of funding would be higher. And as for the IPO space, we hope to see that maybe the exchange could look into creating a secondary trading platform where formal arrangement is made with private startups and allow the startup employees to sell shares. And this is pretty important because as more of these startups stay private, but the valuations begin to hit $1 billion, the workers, founders, and early stage investors, they would still need to realize some of their gains, right? To rechannel some of these gains into something else more tangible to them. So this will provide these private IPO arrangements would give them at least one or two other avenues for them to encash. So this has been done before. So Nasdaq has already established the Nasdaq private markets to facilitate these secondary offerings. And finally, our investment action, we still maintain accumulate a rating on SGX with unchanged target price of $7.99, and we maintain the buy rating on IFAS with unchanged target price of $1.57. So next, we have Richard, who will present the 3Q16 Soilbuild business space REIT results. Thank you.
Good morning, everyone. Okay, I'll just present on the results for Soilbuild. The reporting season has started, so over the next few weeks, you will hear from us talking about results of companies under our coverage. So Soilbuild announced their third quarter results last week. We're maintaining our neutral rating with target price of 72 cents. This year, our forecast dividend for FY16 is full year is 6.08 cents. If you peg that to the last close price last Friday, that will give you a yield of 8.6 cents. So let's look at the results now. For gross revenue was lower, mainly due to obviously lower rental income. That was due to two properties, that's Westpark East Central and Tuas Connection, and offset by slightly higher income from Solaris and Baltic Connection. property expenses was lower year on year, and so that's why net property income was lower by 2.9% relative to the 4.7% drop in gross revenue. Distributable income was also lower year on year. This was in line with the net property income, and DPU was lower by almost 14% year on year. This is mainly due to the larger unit base. If you recall, they had a preferential offering. It was a 1 for 10 preferential offering, so that increased the unit base by about 10%. But if you adjust for the preferential offering, then DPU would have been lower year on year by only 5.7%. So a few key points from the results. Their portfolio occupancy edged up to 94.8%. This is from 92% in the previous quarter. Take note that this occupancy number includes Bukit Batok Connection, which was acquired in the late part of the third quarter. So if you exclude Bukit Batok Connection from the portfolio, then occupancy is actually 94.2. So if you look at from 92 to 94, actually most of it came from organic improvement, and that final 0.6% or 0.6 percentage point is from the inorganic growth of Bukit Batok Connection. On the leasing side, somewhat successful, but there was a negative 6.6% rental reversion on their new leases signed. The new leases were signed at West Park East Central. If you recall, around August, I gave a presentation on the outlook for industrial REIT sector, and two of the key points that I highlighted was that second half of 2016 will be even worse or rather the factory space will be the hardest hit in second half of 2016, and 2017 will be worse than 2016 for warehouse space. So if you look at the rental reversion here, you can see that indeed rental reversion for factory has worsened. First quarter was a negative 0.6, second quarter negative 5.7, and now third quarter negative 6.6 for Soilbuild REIT. Okay, the positive for Soilbuild REIT is that there's limited exposure to interest rate fluctuation. The weighted average lease expiry is 2.2 years with no refinancing till 2018. 88.5% of their debt has been hedged to fixed rate, and they now have a gearing of 36%. Just to give you an update on the Techniques Offshore Property, so if you are following this REIT, you'll recall that one of their tenant at their master lease at this property has defaulted on the lease payment, so they have collected the rental deposit, and now they're drawing down on that rental deposit. And as of second quarter, the manager already said that they're in the midst of looking for new tenants to fill up this space. So the new update for third quarter now is that there are 3 prospective tenants, and the manager said that if the 3 tenants sign their leases, they will have a 80% occupancy for the property. Take note that for this property, if it converts from a master lease to a multi-tenanted property, then property expenses will go up for this, and obviously with a lower occupancy of 80% compared to 100%, then revenue would come down as well. So this is that will be the effect of Technique's offshore property. But at the moment, we have in our assumptions, we have already assumed 60% occupancy for the property. So there could be some price upside left for Techniques if the manager is able to secure these 3 tenants. Okay, we have come to the end of this week's presentation. We'll pause for a moment for questions. And again, I remind everyone that our link for the archive webinars has changed. So please look at the link that I'm highlighting here on the screen right now. This is the new address, so you can watch the previous webinars there, and you can download the slides. So that's the new address here. There's a question on what are the similarities of Soilbuild with Cash Logistics Trust. I think it will be easier for me to answer the question by describing what are the differences. Okay, so for Cash Logistics Trust, the portfolio consists entirely of warehouses, and in terms of geographical diversification, Cash is in Australia, Singapore, and China, but China is a negligible, it's only one warehouse and doesn't contribute much. So you can take it as mainly Singapore and then Australia exposure. That's for Cash. So main difference is Cash is exclusively warehouses, whereas for Soilbuild, the types of properties it holds is generally it is not warehouses. They are business park and factory space. For Soilbuild, all the properties are in Singapore, so it's a pure play on Singapore industrial space. And for Soilbuild, the majority of the properties are on master lease. Cash, their portfolio of properties have been slowly been converted from master lease to multi-tenanted properties. So that's the differences between the two REITs. Is a bit difficult to describe what's the similarities there.
Okay, we have a question on whether the downturn in the bank stocks, whether the downtrend will continue, and how long it is expected to continue, and whether it is a good time to accumulate. I think the downtrend that most people would look at is is stock, right? Because we always believe that the stock price is reflective of what the market is. But I would look at it differently, as a sense that the stock price for the banks, as explained for the last 2 quarters, is that it will continue to be range bound. It's an ebb and flow. So there is no clear trend as to the stock price at the moment now. And what it means from the business point of view, the business is that with the increase of interest rate, there's some negative impacts, and as well as if interest rates remain low, there's also some negative effects, negative impact. So what is happening is that while that is going on, right? The stock price will continue to be in that range because it cannot be sold off completely because there's still a embedded confidence, right? In the banks, the business is still going on. There's still cash flow and etc. So, along the short of it, basically, it is a time to trade the banks, right? And we will monitor the macro picture to see how that would pan out. Because now, of course, interest rates are low. It keeps some of the bad assets from actually blowing up, right? As long as this happens, the offshore oil and gas companies will have that time to fix their balance sheet, whether is it through raising rights or selling off assets, etc. So that this time I would consider is called the breathing space, right? Which, as if the breathing space is drags on, is a lot better for the banks. Definitely, it gives them a lot more room, a lot more leeway to manage all this. But yet, the low interest rates is not good for banks' net interest margins. So how does that play out? So there's always pros and cons for that, and it creates a lot of range bound volatility for the banks. Well, on the other hand, if interest rates were to go up, of course the net interest margins would pick up. But we would also like to see how it affects the balance sheet. See, so for investment action wise, I would say is that don't buy and hold. Uh, do range bound trading. Use CFD if necessary, and I think that would be a lot better for the investor. Thank you very much. Okay, we do not see any further questions. So thank you for tuning in to our webinar, and see you next week. Thank you very much.